Well, thank you all for joining us. It's really wonderful to have the opportunity to report back on all the work and growth that's been happening together. And I was just about to introduce myself, so thank you. I think people may know that Andrea and I are co-founders of Transform Finance. And you'll also see in the video corner there my work in general is as founding partner of Candide Group and their BNME. So I'm really blessed to have multiple partnerships with fantastic men in my life. Is everyone still there?
Yes, we're here.
Okay, you all just disappeared from the video, but that's fine. So what I wanted to open up with was just to provide a bit of history and context. I know some people have been part of the Transform Finance journey from the beginning. Some are newer to the community, and we're thrilled that you're all here. And essentially, the organization grew out of my having been in the impact investment space for about a decade at that point, and feeling a bit frustrated at our lack of accountability and connection to social movements. And spent a year with a small group of global activists to come up with the Transform Finance principles and really think through how we could try to approach impact investment differently. And with that in hand, I was looking for a founding partner, of someone to take the reins as executive director, and was thrilled when Andrea had offered to come on board and really make this happen. And it was really through his energy and then support from a couple key players, so the Underdog Foundation, Deedle Partners, and then Sibley Simon, who stepped up with significant early contributions that made this come alive. And it's been just wonderful to see now, a couple years in, the way that this community has grown and the support that we've been able to offer to the investment community. And with that, I'm thrilled today to share what's really been happening in the organization over the last 6 months. I think a lot of people on the phone have different touch points to it, right? So members of the investor network sort of know the support work that Transform Finance has been doing, one, with the network generally in providing content, and then two, with some of the more custom consulting work that the organization has done. But that's just one side of this work in terms of bridging finance and social justice. So we wanted to make sure to get to share the broader work that's been happening. And then finally, what's really critical is to make sure to have the opportunity to publicly acknowledge and thank Andrea for the incredible work that he has been doing to lead this organization and the whole team alongside Kurt and Eric and others. So with that, I will hand the mic over to Andrea, but just wanted to offer the board's welcome and to make sure to really thank Andrea for all the work that he's done for this community.
Well, thank you, Morgan. As always, that's extremely sweet of you and very considerate. And I've been honored to be working with you on this for about 5 years now. So time flies. For those I don't know yet, welcome to this webinar. My name is Andrea Armeni. I am the Executive Director of Transform Finance and co-founder with Morgan, and the lead convener of this Transform Finance Investor Network, which is a community of practice of asset owners, managers, and other practitioners that are really interested in exploring deeply this intersection of social justice and finance, and trying to find practical ways in which we can deepen our work over time, right? Never really being quite satisfied with where we are, meeting everyone where everyone is, but over time really moving towards this transformative edge of impact. Very much as Morgan was saying, starting from this perspective that a lot of what has been happening really has not really been grounded in the work of the communities that we ultimately would like to support, nor has it been grounded in a broader sense of a movement around transformation through finance, as well as transformation of the finance space. So I thought that since a lot has happened, we could talk a little bit today about what is going on in the world of finance and progressive finance, especially what we've seen over the last few months, good, bad, and ugly. Then give you all an update on some of the specific projects that we're doing and that we are particularly excited about. And as you know, we are always keen to collaborate with others, whether it's folks from the investor side or from the movement side. So, to create the bridge that we set out to do 5 years ago between the world of finance and the world of social justice, it will take a lot of partnerships, and it will take a lot of actors that are oftentimes not part of the same conversation. And I'm extremely grateful to all of you that have been part of this journey and remain very active as members of our community or otherwise supporters in many ways. And as you'll notice, even from your fellow attendees, it is a very varied community, right? We have some frontline activists, we have asset owners, we have fund managers, we have advisors, and our hope is to break down some of those silos and some of those barriers and really be able to all be part of the conversation and of the transformation together. So let's start from the broad view of what has been happening over the last 6 months, and I will give you a couple of very quick kind of touch points. By no means am I trying to be comprehensive, and hopefully you all can tell me about what you have seen that you think is relevant to things. And again, as a framing for that point, we need to be thoughtful about what it means for something to be moving towards transformation, right? It's not always obvious. There are some things, such as work that is happening at the community level, that is quite clearly part of this deeply intentional building of the new that we want to see through finance. But there are also some elements of it that are moving us along that continuum. And one of the things that is particularly exciting is, from my perspective, and this might be controversial for some of you, seeing a general narrative shift among some of the big players. You all might remember we started the year with the Larry Fink letter as CEO of BlackRock, saying that the duty of business goes beyond just profit maximization. Not a point that would be controversial to any folks here, but certainly something that is a little bit of a major shift for somebody that is managing about, God knows, $6 trillion, some ridiculous number that to me makes absolutely no sense, but gives us a sense of the scale of the challenge that we have as we seek to transform finance, right? It can't just be at the very small bespoke level. And we saw from the recent GIN update that came out, right, that assets that somehow qualify as impact have doubled. And I think that the question is the same for both of those positive trends, right? What does it mean for them to be considered to be impactful in some ways? What does it mean for Larry Fink to say that that the business of business goes beyond just business, but really has to have a social license to operate? Who will decide what that is, and how are they going to be held accountable? So I look forward to seeing next February or so, 12 months into the Larry Fink letter, whether anything has changed. And you all active in the shareholder resolution space might have seen that there have been some progress on the part of how BlackRock is voting its block of shares, but also some disappointments, right? This has not really been a very consistent performance in that sense. But I would like the approach that we take to be one that is supportive, really, and organizing and informative of these efforts, rather than perhaps my own personal bias that would be, as you all might have seen, to sort of be very skeptical and poo-pooing a lot of this effort. So in my maturity, as I become an adult finally, I'm thinking more about ways in which we as an organization, I as an individual, can really say, okay, that's great, let's see what you're doing, and let's move from that to the next step, and we'll hold your feet to the fire with it. Which I think puts us in an exciting and in a bit of a more powerful position in some ways, right? It's moving from protest into power. So there are some things that have been moving in the right direction, and I think that there have been some steps back, definitely some missed opportunities, and some major missteps. And I'm looking here mainly at the federal level and at the policy level, to be frank. You also saw the very ambiguous guidance, field guidance that the Department of Labor put out around ERISA and ESG considerations by ERISA-controlled funds that some folks have spinned as a confirmation of the Obama-era changes. Others have said this puts us in a very ambiguous position. We really don't know what to do. But we can also think of step backs around organized labor in the context of the recent Supreme Court decision, and certainly, again, perhaps somewhat controversially, with the new tax bill. And I think of the tax bill as a missed opportunity in this case because of the excitement that there was around the rhetoric of the tax cuts actually being plowed back into the real economy, right? Being used to support workers, to support R&D, to support growth, to increase wages. The reality is pretty grim. The data is not good at all. Most of that capital has in fact gone to share buybacks, which really suck the capital out of the real economy, contribute to financialization, and really reward shareholders just for the fact of being shareholders. To the extent that we have seen some increases in worker compensation, they have not taken the form of wage increases, but they have been one-off type of payments, which is problematic again because it does not increase the base by which workers are being compensated. And as a subset of the tax code, I would mention the opportunity zones too. You all might have been on our recent webinar trying to parse or read the tea leaves of what could happen with opportunity zones. And as you might remember from our analysis then with Franz Siegel from the U.S. Impact Investing Alliance, it doesn't look too good, right? There are no parameters around what actually would be an investment that benefits a community rather than the usual mere placement within a community that has been determined to be an opportunity zone. And these things, as you know, the Opportunity Zones program is based on a tax abatement or a tax deferral, and as such, it undermines intrinsically the tax base, which is something that, again, some people say, well, good riddance if we are limiting the tax base for the current federal government, but the people that ultimately bear the burden of that reduction in the tax base are the most marginalized and oftentimes the ones that would most need the support that comes from a healthy tax base. So we're not going to go into the issues of the Opportunity Zones program, but let's keep in mind that this is a tax advantage for unrealized gains for investors, right? Not a tax advantage for communities, not a tax advantage for workers. And insofar as the reinvestment is concerned, we have not really seen much of a parameter, much as we haven't seen in the context of the Community Reinvestment Act, for example, as to how really we would measure and who we would be accountable to with respect to those investments. And I imagine you all, again, if you want to chime in later, might have seen other instances of good direction, steps back, missed opportunities. And I also want to lift up some of the really interesting contributions that have come out lately because they've been sort of across the board in many ways. I think that the call to action that Rodney Foxworth, the incoming executive director at Bali, put out really around a major narrative shift on finance and extractiveness and what the progressive finance movement is doing has been taken up by many of you in an intense comment way, and I think all of us have to reckon with Rodney's call to more meaningful action. We've seen some very interesting work in the just transition space. There's a fantastic paper that I recommend to you that David Wood at Harvard, Nick Robbins, and Vonda Brunstein authored recently on the role of investors in the just transition away from a carbon economy, who is being left behind, and what is it that investors can do to ensure that those that are more marginalized are not left to bear the brunt of the transition away from the carbon economy. So those are some of the things that generally I think we've seen over the last 6 months that have been quite exciting. Now, what have we been doing, and how have we been trying to intersect with all that is happening around us, all the way from BlackRock to the Boston Ujima project and similar place-based, deeply social justice intentional type of initiatives that are now flourishing. We continue to support investors and communities in a variety of ways. We think that there is so much to be done to meaningfully transform finance, and that ranges from our efforts around thought leadership, as we do in this context, convening conversations, convening working groups in a variety of ways, really supporting the work, especially of those that have historically not been engaged with the world of finance, especially at the activist, social justice practitioner and community leader level. The work that we do through our Institute for Social Justice Leaders and through our soon-to-be announced cohort program, which will be a more advanced version of 1 year of support and fellowship for organizations that have not historically worked with finance and that are developing new capital strategies, which we're very excited about and would like to keep you in the loop on. So out of all this work, I want to highlight a few of the projects, and I'm honored that I'll be joined in doing this by some of my collaborators and co-conspirators in this work. These are in no particular order other than how I was thinking about them as we were working through all of them in parallel during this past week. So I will mention briefly the first and then turn it over to Meredith Benton, who's the project lead on this. This idea of repurposing financial innovation for social change for institutional investors. Thinking, again, going back to one of the earlier points about BlackRock, there are a lot of asset owners out there. There are a lot of players that really want to do something different. And historically, they've been in a position to do it through a combination of divestment and engagement, if we think about the public markets. But those are two fairly blunt instruments, I would say, and they leave a lot of opportunities on the table. And if you consider that divestment engagement as strategies haven't really changed for the last 30 or 40 years, but think about the ridiculous amount of improvement and change that there has been in terms of organizing and in terms of financial instruments that have come up, whether they are technological or technical changes, but also big data, whatever you want to think. We really wanted to explore what are the many new possibilities that have arisen for otherwise more traditional institutional investors to play a role that goes beyond, the binary, as it were, of divestment engagement. This work is supported by the Ford Foundation and the Rockefeller Foundation. They have really been thinking about how we can combine fairly transformative, certainly very innovative approaches with the scale that is needed to tackle the problem that we have at hand. And with that, I will turn it over to my colleague Meredith, that has been the lead on this project. Meredith, please tell us a little bit about this work.
The big picture question is, what's changed in the marketplace since essentially the 70s when we really embraced divestment and engagement as social change tools? Now, the marketplace itself has shifted very dramatically since that period of time. Andrea mentioned some of these things, but we've seen a huge range of alternative investments. We've seen sort of the buyout fund ethos. We've seen an inordinate amount of technological change. And all of this shifts the opportunity set that we have as investors who are also interested in social change. And that's fundamentally the project motivator, is can we review what has occurred and find new tools and new opportunities that can complement what the work that has already been done around divestment and with shareholder engagement. So if you want to move to the next slide. Yeah. So the goals of the project here are essentially is, can we take the data that we now have, which is around environmental, social, governance indicators, can we take the data that we now have around the importance of these issues, their meaningful corollary to strong returns, can we take that data set, can we apply it to some of these financial innovations and changes? Can we look at some of these financial innovations and changes and apply them to what we know are the needs of the social change movement? And do we need to create something new? We have to combine some of these existing tools with some new concepts? And if we are creating something new, is that new creation something that would be feasible and appealing to the institutional investor marketplace? Can we create, or can we encourage the use of some of these new innovations in the marketplace so that we can really drive forward social and environmental change in a meaningful way? That's really the big goals of this project. What we've done to do this, so here's the strategy on doing this, right, is to say, first of all, is this needed in the field? Is anyone else doing this? So we did that. It wasn't happening. And then we looked at, so number two, we looked at the landscape. We looked at what do the social change movement leaders, what do the NGOs say that they need? What are they struggling with? And particularly, we looked at what are the things that they don't have other tools to address. You know, what are the barriers for a successful social change movement? And maybe we can think of something, particularly as it relates to financing and voice in the marketplace. We also looked at who's currently an actor and a leader around creating these social change differences, within the financial marketplace. What innovations are we already seeing? What's been successful? Where have the challenges been? Right? Just an understanding of the landscape. That's been completed as well. We're now at stage 3, the innovation review and feasibility analysis. So we've done an extensive review of the changes that have occurred in the marketplace. We've looked at a wide range of financial instruments or strategies, programs that have come online, right? Press releases from the wildest and weirdest of places. And we've said, what among this actually seems applicable to what we're trying to do from a social change perspective? And we've come up with a long list of ideas and then a short list that we're prioritizing for conversation and for really doing a deep dive to understand what we can do to either use the tools as they exist now or to manipulate them so that they can have real ESG impact. And I'll go into that on the next slide. The last, just to go back 1 second, the 2 stages after this is we're intending to publish the findings that we have, and then we're intending to have a convening of the practitioners that we are hoping would actually allocate capital, right, to make sure that this is something that they would really be interested in doing. So what we're doing is we've taken these. This is 4 examples of a short list that's about right around 8 right now and is growing out of around 50, 60 ideas that we've culled together from many different places. What we're doing is we're developing an advisory board who can sort of guide us, especially from the institutional investor perspective. And then we're also talking to practitioners in the field who are involved in each one of our prioritized instruments to have them tell us, hey, this is a crazy idea, or refine it a little bit this way, or perhaps if you were to just shift it, right, this is where we could see the application of the concept. So we're having those conversations in real time. But I wanted to show you a couple of examples, and I don't know if you'll be able to read these on your screen, but a couple of examples of some of the things that we're really pursuing, right? So shorting and the idea of shorting a stock, that's been a huge change in the marketplace. And you can look at that in a couple of different ways with a really strong ability to have a social impact. So the funds that do activist shorts like Ackerman and Herbalife, right? Can't we apply that to companies that we know have egregious social and environmental practices? That's really driving forward social change. If we say this issue, say we could do the research that would let us see BP's explosion before it happened, right? We're going to short that stock, and we're going to go to the marketplace and say these guys have unacceptable practices. not only would it change the way that BP was acting, but also the industry around it. That's an impact driver. When we look at shorting and shorting as a tool, we can also look at long-short funds where an investment manager can say, I have more confidence that this stock is overvalued. I have more confidence that this stock is undervalued. And they can build their portfolio around the concepts of both, this is a good purchase, I think it's going to go up, and I don't believe that this company is managing ESG issues well, therefore I'm going to short the stock. That allows them to go literally beyond divestment. They go from not having any exposure to a stock to having a negative exposure to the stock. Another idea that we're looking into and we're talking to practitioners in the field about is this concept of the convertible bond. If you have right now, if you were to invest, if you were unsure about what interest rates would do, but you needed a fixed income stream, you might invest in a convertible bond, which allows you to go from a bond that's been issued by the company and then to shift that into shareholdership, an equity stake in the company, allowing you to participate in the upside of the company if it does well. Well, couldn't we make it so that you could offer a lower interest rate? You could say to the company, it will be cheaper for you to raise money. We will give you more money in exchange for less on the fixed income side if you change your social and environmental practices, because we have so much faith that your stock price will go up, that we will lend to you at a lower rate. But we need you to change your human rights practices. We need you to increase employee participation. We want to see more diversity. Really drive change in a collaborative way. So that's sort of these are the different types of ideas we're looking into. So the invitation I would make, and I've almost a request I would actually shift it to, is that we're looking at all of the weird and wonderful ideas. We're looking at all of the practical and pragmatic ideas, right? We're looking at all of the ideas. So we would love to hear anything that you might have thought of, you might have seen across your desk that you think, why couldn't we apply this from a social change perspective? Please be sure to share those with us, and we will research them. Thank you.
Great. Thank you so much, Meredith. I really appreciate that. And I want to emphasize that this is really quite an interesting way of saying what can be this reconceived relationship between movements and the world of finance in a way that is practical, operational, that actually results in investable activity, which I think has been a core you might have seen in our work. There's been a shift over time towards more and more of this work around instruments that can drive the change, since most people, at least the ones that we interact with, are fairly sold on the need for it and need most of the support with understanding how to do it and what are the practical ways in which it can be done. I will mention briefly our work around racial justice, because it's another example of this intersection between movement and finance in a way that I think is done properly, or at least is done in accordance with the values that we try to bring to this work. And there have been a lot of initiatives around diversity and inclusion, as you all know. Some have been quite powerful lately, again, in the shareholder engagement and the proxy voting side. But our thought was, what if we flipped the equation a bit and we thought of capital as being one more flank, one more strategy within a racial justice agenda that is actually driven by the racial justice practitioners and racial justice leaders themselves, not driven by the investors as a separate thing. So our work in that area is trying to lift up all the ways in which racial justice manifests in an investment portfolio, many of which are not obvious and many of which, unfortunately, are detrimental. It's rare that you see an investment that just happens to be aligned with better racial justice outcomes. So we thought, if you are a meaningful asset owner concerned with racial justice, what do you need to know in order to be able to align your portfolio? What are the real drivers of justice or injustice that appear then? And many there are not necessarily racialized on their face, and many of them certainly are not quite obvious. We look at things by sector or by theme, with the help of our researcher Stephanie Lane Pavone on this, like the intersection of race and jobs, and how it is that finance is contributing to negative results in that sense, right? If you care about racial justice, you should care about the quality of the jobs in your portfolio, even if they are not racialized on their face, because more of the low quality jobs tend to accrue to communities of color, in particular to women of color. But again, we can go back to the share buybacks idea, which, as you know, is one of my obsessions. If you invest in a way that drives returns from excessive share buybacks, you are essentially sucking this capital out of the real economy into a world that is dominated by white male asset owners. So you're not really driving anything towards racial justice, even though the issue is not racialized per se on its face. If you are in particular an asset owner or a manager or an advisor that is interested in this approach, again, we would encourage you to reach out to us as we plan over the next 5 months or so, I think, to release our final recommendations, highlighting the type of things that investors might want to look at if they want to drive racial justice across all asset classes, across all sorts of different initiatives. Again, ranging from what your municipal bond portfolio could look like, to your allocation to private equity, to hedge funds, and not in an accusatory way as much as a supportive way of saying, hey, let's lift up what are the ways in which racial justice is really being affected here. A third piece that has been very exciting, and I'm glad to have both Aner Ben-Ami and Jack Bugas to talk with us about this, is that as we thought more about the operationalization of the transformative finance principles of deep community engagement in design, governance, and ownership, non-extractiveness, right, the creation of more wealth in communities than what is being taken out by investors, and the fair allocation of risks and returns among stakeholders, well, we should really get a little bit more specific. We might want to have a concrete methodology that would allow us to say, look, the impact that you're having is not just on the product or service that a certain company or a certain enterprise is putting out, but it's likely to be on 2 other fronts as well. One is the structural piece of the enterprise, right? What are the jobs? What does the supply chain look like? Where is wealth being created? Where are the opportunities for wealth sharing and for sharing of voice and power ultimately beyond just the wealth itself? But also, like, how is the investment itself impactful? And this is the thing that, again, not everybody agrees with, but saying, like, you know, as an investor, are you making a difference by being on that capital stack or by being present in a particular investment yourself? Aner will tell us a little bit about the genesis of this work with an example from one of the companies that he has been intersecting with, and then Jack will help us through the methodology piece. Thanks, Aner. Let's chat a couple of minutes about this, and I'll turn over the slides to you.
Great, thanks. So do you want us to then get into the example with OGC now? Okay, as well, thanks. Yeah, no, so just to reiterate some of the framing that Andrea provided, and to introduce myself here briefly, I'm Aner Ben-Ami. I'm on the advisory board for Transform Finance, and also with Morgan Simon, founding partner at Candide Group, where we essentially kind of bring to life and apply the social justice principles of Transform Finance in the context of real portfolios. And we're an investment advisor and work with families and foundations who are committed to deploying their capital with a strong emphasis on social justice. And we do this across sectors. And one of the statements, the ways we we often describe our work and our scope is that we often like to say that we care as much about the how as we do about the what, right? And so what that means is, if we're investing in or trying to address or trying to bring capital to address wealth, income, asset inequality in the economy, and we're trying to help support an economy that is less extractive and more more just and equal, then we should be applying that lens to the whole economy, right? We should be applying it to any sector. It's not just about the companies that are specifically building products or services that address financial inclusion, or that address climate change, or that are are building cook stoves or solar power. Those companies as well, we should be applying that lens to those companies as well. But really, it's about the economy as a whole and how it how we define, or how we help redefine or redesign a financial system that just works for more people. Right, and so that's sort of the genesis of trying to develop an impact framework that is aligned with that philosophy. So maybe to jump into one example here of a company that we're currently, an investment that we're currently working on, I think exemplifies this sort of thinking about impact in a very holistic way. I'll note this is still an in-process investment. It's still live, so in a very innovative structure. So please feel free to follow up with, or chime in with questions or comments, or follow up with questions, because this one is still very much a live process. So the company is called Organically Grown Company, or OGC for short. They're a Oregon-based distributor of organic produce. They've been around for 40 years now. They're the largest, currently the largest independent organic produce distributor in the country. About $160 million in sales. They've been growing for 30 years. They've been profitable for the last 25 years. So they've been a leader in their sector for a while. And beyond being an organic produce distributor, they're incredibly mission-driven in sort of everything they do across the business. So they define their mission as promoting health through organic agriculture. They've always been incredibly focused on small local growers. They've been a leader in advocacy and organizing on behalf of their sector. They launched this thing called the Sustainable Food Trade Association, all about setting standards for their peers around sustainability and labor standards, supply chain standards. Their commitment to renewable energy and zero waste and local organic sourcing. They've always, as I mentioned, been very producer focused, and have made specific investments that kind of empower their local producers and smaller producers to reach the market. So this is a company that certainly is that DNA of the how, right? And the DNA of the mission is incredibly strong and embedded, and would score very. We'll hear a little bit more from Jack later about the specific metrics or criteria we'd look at from a kind of how perspective. It's not just the what. It's not just that they're an organic produce distributor. They really think about the benefit for their growers, for their workers, environmental stewardship of the company. So they would sort of score very highly, obviously, on all of those questions. And where they've really struggled over the years, or where they've had a lot of iterations and experimentation over the years, is to find an ownership structure that would enable them to kind of pursue their mission over the long term. And they've tried various things over the years. They started out as a nonprofit. Felt like they're essentially a commercial business. They shouldn't be a nonprofit. They transitioned into a grower co-op in the 80s. I think then some questions around being overly skewed to sort of that stakeholder group, the grower stakeholder group, and then transitioned into an ESOP over the years, and the company has been progressively, I think currently about 40% owned by the ESOP. That's been a process where towards becoming a fully owned ESOP. And now this is another transition into this new model, which is a purpose-driven trust. So before I explain what that next model is, what was really interesting here, some of the issues with the current model for them. So we're big supporters. One of the other projects Andrea will be discussing is a worker ownership conversion project, or big supporters of worker ownership models and democratic ownership models. And but it was interesting to observe how, in this case, they felt like the ESOP model had some very serious shortcomings for them. First and foremost, they felt like it didn't provide them from the protection they wanted for from potentially exiting and selling the business, because the ESOP, the trustee, is subject to the ERISA exclusive benefit rule, which means essentially that if they receive an acquisition offer that is beneficial to the beneficiaries of the trust, i.e. the workers, they need to consider it and potentially accept it. So it didn't provide the protection from exit that this company was looking for. It also felt like overly focused on one stakeholder group, and they really wanted to define their stakeholder group more broadly, including community organizations, growers, workers, so multiple stakeholder groups. And they also found that with the ESOP model going through the annual share valuation process that's mandated, regulated by the Department of Labor, again created the wrong sort of set of incentives. The share price kept increasing every year, which meant they have to continuously fund their liability to the workers so that they can then buy them out when they need to, and again kind of found themselves on a treadmill they didn't want to be on in terms of working towards a share price outcome versus the mission outcome. And then the Perpetual Purpose Trust was the solution they came up with. Pretty interesting application here. What it means is a purpose trust is more flexible than a charitable trust. You can define its mission or its purpose more broadly. It doesn't have to be strictly charitable, and the purpose here is defined as supporting the vitality of organizations, advancing health through sustainable ag and food systems. And so that flexibility was useful for OGC. It's also helpful that the beneficiaries are not as limited. So, for example, if they went with an employee owned trust and EOT, the beneficiaries would be solely the employees, and here they can be defined more broadly. So this is kind of an interesting application of an existing trust structure that has never been applied quite this way. But the bottom line is really a structure that prevents the company from having to exit, and where the profit, and they feel like the profit and the health of the business is in service of that purpose and that mission.
Cool. Thanks, Anair. So I suggest we keep in mind what Anair just presented, really with this idea of saying how is the impact here on the structure of the ownership and the governance of the company, rather than so much the what the company produces, even though in this case it does happen to be an organic goods company. And then after Jack has walked us through the methodology that he developed with us, we'll bring it back to Anair to see how that can help inform a decision such as the investment in organically grown. Jack, thank you for joining us. Over to you, and you should have control of the slides too. Thanks.
Excellent. So, hi everyone. My name is Jack. I am a Kellogg MBA candidate, and I had the chance to work with Anera and Andrea on the Impact Scorecard over the last several months. Okay. So the overall orientation for this scorecard is that we're taking a comprehensive view of impact. So one of the original objectives that I was discussing with Andrea and Anera a few months back was the idea of making sure that we take a holistic view so that there's not any impact that's left on the table, and also a view of unintended negative impacts. So I'll go a little bit further into what that actually looks like, but the idea is we're looking at both the product and service that a company is providing, and then also their indirect impacts and the impact of the investor and the investment. And then secondly, the scorecard is guided by the transformative finance principles. So the social justice orientation is really embedded into all of the metrics across the scorecard. And the idea at this point is that it applies to early stage equity and debt investments, but the principles and the structure for it could be applied to other asset classes as well. So before I continue, I just want to give like a quick comparison for why this scorecard is additive when there's already a lot of impact measurement systems in place today, Gears obviously being probably the most widely used one, but plenty of others. So I've talked a little bit about the overall methodology and the social justice orientation in the way that this scorecard could be used as a roadmap around thinking about impact comprehensively. On the impact scope, I just continue to point out the combination of metrics here, and investment structure I think is one that doesn't necessarily get looked at through typical reporting metrics. So as an investor, how are you balancing risk and reward? How are you signaling the viability of a new business model, or driving catalytic capital, or organizing in the field? And then at the portfolio level, what's the delta of your impact as an investor? Are you augmenting impact? Are you combining synergetic investments that contribute to a whole that's greater than the sum of the parts? We've kept it quite flexible. So the tool itself, it's a scorecard that could apply across any different sector, which is a big challenge to have one set of metrics that you could use in fintech and in sustainability or climate change. So having that flexibility was really key, and there's a number of ways that you can kind of turn on and off metrics or weight things differently in order to be able to tailor the scorecard to the relevant metrics that you really care about for a given investment or for your investment thesis. It can be used as an audit where, at the end you're able to get a kind of a few key numbers out of this and compare how the investments across a portfolio might score. But it can also just be a guide for discussing some critical questions and raising perhaps some uncovered areas of impact that can be better aligned going forward. So you can use this for assessing your current portfolio, which is what we've been doing largely at this point to test the scorecard. But it also can be an ex-ante tool looking at investments as you're going through the diligence process. And it could be a checklist to think about deepening impact and a roadmap for you as an investor going forward. The next slide is an overview of these 4 types of impacts that we've talked about. The direct, which is really the product and service, the indirect and the investment structure, and investor delta. But I think we can flip to a specific example for what this looks like.
Yeah, I'll make one quick addition there, that even within the direct impact, which is what most is looked at in the thematic approach to impact investing, we're really looking at whether this is a transformative difference. Is it serving a meaningful problem for a population for whom problems are often not being solved? Is it something that will be transformative at scale? And interestingly, we try to net out, even in the direct impact side, the countervailing impacts that could be happening. And frankly, if you look closely enough, you don't see a single investment, even in the thematic way, that does not have some potential for a negative countervailing impact that we look at.
Thanks, Andrea. Cool. So should we flip to the next slide then and go through a specific example?
Oh, sorry, if you want to go through the indirect impact, investment structure, the delta, yeah.
Okay, yeah, happy to keep walking through them. So the indirect impact, this is looking at, practices, processes, places. The buckets that are under this include employment practices, which would be things ranging from employee diversity to the quality of the jobs. It includes community practices, which is the extent to which you've incorporated the community into the design of the product or service being offered, and the way that the community, by which we mean the beneficiaries of this product or service, have the ownership stake or at least a governance or advisory stake, which gets to what Anair was talking about. And then how are you in turn strengthening the external institutions through the business. Another bucket under here is environmental stewardship. So not just the direct product or service, but in your processing of the production, in your sourcing, and in your corporate operations, to what extent are you a steward of the environment and using those processes to actually to deepen the impact beyond just the surface level product being offered. And then the fourth bucket under here is the potential for impact at scale, which includes your potential for scaling up and having a model to transfer to other markets, and then also the extent to which the enterprise is an advocate in this area and organizing other players. Under investment structure, the three main buckets here, the first one is alignment of investment terms, which is around risk and return and whether the investor can really justify the return that they're generating, is it commensurate with the risk that the enterprise is undergoing, and then alignment during the exit if this is an equity investment. The second bucket is crowding capital, which is more around, are you driving catalytic capital? Is this a investment that signals the viability of a business model? And then the third one is around influencing the field, whether this investment vehicle is a creative or innovative vehicle, and whether you as an investor are using this to engage with a broader array of stakeholders. And I think there's a few ways of looking at this. There might be an innovative investment vehicle that's a combination of a concessionary grant as well as an equity investment, and there could be multiple tranches. And then there's a question of where you as the investor are. Are you in the riskier tranche or are you in the more secure tranche? On the specific example here under indirect impact, you can just see, this gives a little bit of a view on how we're scoring. So it's a qualitative score from 0 to 3, but we've tried to be flexible around what this means again, but precise enough to be able to give a consistent score. And we've been calibrating that across a bunch of trial runs over the last few weeks. So you can see in product and service design, a 0 would be essentially that the community was not really incorporated into the design of the product until it was developed and then just tested before launch. And then a 3 on this would be that the idea actually originated from a need that was recognized by the community, and the entrepreneur is sort of a servant leader. And you can see here also that there's a negative, a potential for getting a negative score, whether there's a countervailing KPI or there's some reason why the community is actively ignored in the design of the product. And this rolls up, this is one of 3 metrics here within community practices, which rolls up to indirect impact. And there's 25 of these metrics in total. Again, the weighting between it can be adjusted. And the idea is you would then come out of this with a view of relationally, how do your investments in your portfolio compare, and where are the spikes, where are the areas where you're at potentially not maximizing your impact, and is that intentional or is it missed opportunities? And then pulling that into a set of recommendations and a roadmap for what this means in terms of deepening impact going forward.
Excellent. Thank you so much, Jack, and thank you for all your leadership on this. And I do want to make sure we acknowledge that, in particular around the indirect impacts bucket, this has very much been based on the work that Anair and Morgan pioneered at Candide with their own community impact methodology, which lies at the core of this, and is an expansion on all that work. And many of you with respect to the third bucket might have heard big echoes also of the work that we've been doing over the last 2-3 years around alternative deal structures, innovative deal structures, and how those can be intrinsically impactful by themselves, or conversely, how there are a lot of investments that lose out on their impact because of the structural aspects of that investment. This is very much a work in progress, so I invite Anair to tie it back to the comments about organically grown company, and I would invite all of you that are hearing this to give us your thoughts. Is this something that might be helpful? How does it fit with your work? Would you view it as something that can help you pick up more impact, or maybe give you some ideas and considerations for how to create impact synergies, as it were, through a new iteration of the portfolio? So this is very much a tool for you all as you seek to operationalize the Transform Finance principles here.
Yeah, I'll just call out a couple of quick things in the context of OGC that we think sort of deserve to be captured in the methodology. So one, obviously, the investment structure, right? So this trust-owned company where all the stakeholders are benefit from profit distributions. Preferred equity investors get some sort of a preferred dividend, and then there's upside beyond that that is shared across all the stakeholder groups between investors, growers, workers, and community organizations. So that in and of itself, this sort of mission protective structure, we think deserves kind of mention when we consider how impactful an investment is, right? And then beyond that, there's one of the elements around the indirect impact is the element of organizing and advocacy. I already mentioned OGC has always scored high in organizing and advocacy towards deepening impact. Specifically, as it relates to this investment structure, they are very actively kind of promoting and advocating this within the organic food industry. And as you probably know, this is an endemic question that organic food leaders face, right? There is kind of succession planning, that there's the, how do you survive for the long term and stay true to your original values? So the fact that they are very actively educating, promoting, advocating for this structure with others is another plus that we want to capture. And then the fourth bucket in the that framework that Jack shared, which is the investor delta, another thing we want to share, right? So we as investors, alongside another fund that presented in a previous webinar called Purpose, have really rolled up our sleeves to kind of to help figure this out, right? This is a new concept. It has to be a very collaborative process between the investors and the company. That too should be captured, right? As we think about kind of the investor, the overall impact of the investment, right? The additionality and the delta as it relates to investment structure, but then also as it relates to other business practices, right? If we continue to engage the company over time around governance structures or job quality factors, that also we want to capture or not. I think that's those are the main elements as an example here. But happy to go offline with more details on either OGC or the impact framework.
Great, thank you, and thanks for highlighting also, that investor delta piece that I think oftentimes is a little bit overlooked and goes to a deeper consideration that we're seeing emerging now of investing in best in class, right, in things that are already having fabulous impact and being well structured versus getting amongst it with something that is sort of like middling along and doing its thing, but where you think that by being one of the investors, you can drive things in a positive direction. And this is something we highlighted last year in our work on renewable energy and human rights, where in consideration of the fact that there are meaningful human rights violations and human rights concerns in renewable energy investments in the global south, as an investor, you can have that big delta, not by just investing in the ones that are perfect, but in saying, let's put in some terms very concretely, whether it's as an LP in a side letter, or whether we say for every investment that we make, even down the line, we want them to have been done in a certain way, right? It's a lot more than just bringing in the capital. It's taking that very proactive role to say, let's take something that is a 2 and bring it to a 3, which again might be familiar with those of you that followed our work around job quality standards and how you can have a floor and a ladder approach, and your delta could be to contribute to that ladder. Great. So I'm going to turn it over now to Camille Kerr, that will walk us through quickly the work that we've been doing around employee ownership, and in particular the conversions in a succession space, just to give a quick look at what we've been doing. Thanks, Camille.
Of course, Andrea. So can you all hear me? And how long are you thinking that I should talk here, Andrea? Can you say quick?
How about 5 minutes tops?
Perfect. Okay. So first of all, Anair, that was really interesting, and I would love to talk shop with you, because we're building, looking between like stated purpose LLC and a purpose trust for one of the projects we're doing, and getting some legal advice there, which is so we're trying to do the same thing as you are, and getting some interesting legal structures out of it. So let's talk shop. So I'm here mostly to talk about this investment vehicle to foster conversions to employee ownership. So I want to start with I'm sure that you all have at least heard of employee ownership, but I want to just start with a quick overview. This is when a broad base of employees, so not just executive ownership, a broad base of employees, that's all the employees who make basic eligibility requirements like tenure, own a significant percentage of the stock. And we're usually hoping for a majority of the stock, but at least 30 or something percent for it to be a significant percentage. And the benefits of employee ownership, and there's a lot of, there's some data to back this information up, is that it builds wealth for the employees themselves. It roots companies in their communities. It can cycle wealth back into the community. There's data to show that during the most recent recession, it increased the resilience of companies. It also offers a succession planning option for private companies that might not have other options, or have not, don't have options at this point because they hadn't been exploring them early enough on. So there's a couple of demographic and other shifts that make that have contributed to a really important opportunity right now. When it comes to employee ownership and scaling employee ownership as a way to achieve all of those benefits that I mentioned. One is the silver tsunami, as they're talking about, which is that a number of baby boomers are gearing up for retirement. And as a result, there's a lot of companies that are on the market that might, if not for, that might otherwise close, even though that they're perfectly healthy companies. And additionally, there's a lack of succession planning. I think the statistic is something like 13 or 17%. That's the amount of people the percentage of owners who really considered succession planning. So, and we're also looking at a major cost to not acting on this. Losing these businesses and the jobs that they provide can be devastating to communities, and can really exacerbate the issues that especially marginalized communities, rural communities, other places are experiencing, because they might not have capital access to replace these services and jobs that these businesses leave behind. So just a little brief thing on why employee ownership isn't as common as we'd like it to be now, and why these transitions aren't happening at the rate we'd like them to be. One is just like a lack of knowledge by owners and their advisors, a lack of familiarity by finance institutions about what it's like to finance these things. And then worries, a couple worries. One is like that it'll take longer, this idea of employee ownership. And the second one is really concern about some high profile employee ownership abuses and issues that really made it so that it didn't build assets for the workers in the way that the structure has the capacity to, the way that it was designed to as a legal mechanism. So what are we doing? We're creating an intermediary fund, and this is going to operate a lot like private equity in that it'll hold businesses for a 3 to 5 year period, and then transition them 100% to employees, or possibly over time transition out to employees as the exit strategy. So what this solution does, and I'll talk a little bit more about the different aspects that we're thinking about designing right now and how we're doing that. But what this does is it creates capital that's available to be deployed immediately. A lot of the issue with employee ownership transitions is that you have a company that might be interested in the idea, but they're like, where's the money going to come from? And then you start the process with capital providers who might not understand this. So it takes a really long time. So this fund would have money to launch immediately. It's the right length of time for a conversion. So when we're seeing conversions that are happening right now, it's basically a one-year transaction period using a combination of seller financing and debt. And then is that the right amount of support from the technical assistance community to make sure that this is really providing the value and culture of employee ownership that makes employee ownership so powerful? Whereas a 3 to 5 typical private equity timeline does achieve that. And it makes it so that across these deals, we can build in efficiencies and capacities that make it so that there's more capital for both the investors and for the employees in a way that an individual deal does not achieve. And, it really can increase the number of these businesses that we save because otherwise they don't have that option. And just a quick note about where we are before I hand it back to you, Andrea. So one, we've been thinking and talking about this idea for years. If you've been on these webinars for years, I think we've mentioned it over the years. But right now, we're aggregating data about the opportunity and pipeline and the current deals that are happening right now so that we can really demonstrate where the field is. We're modeling out the deal economics. What is the capital stack and returns for an individual conversion deal? And then we're exploring the fund models. What makes sense to really achieve these practices and maximize how we score on these different aspects that Anair is talking about in terms of fund metrics. What financial models really make it so that we maximize the impact on those axes, as well as getting the returns to investors. So we're going to be, working through this over the summer, and anybody who's interested in advising or being a thought partner in this, I'm welcome to reach out to me. I'd love to hear from you.
Fabulous. Thank you so much, Camille, and thank you for all your work on this project. I'll make one quick but important clarification just to avoid any confusion here. We, as Transform Finance, would not be running such a fund at all, right? That's not what we do. We are a field-building organization, and as part of these conversations, as Camille mentioned, that we've been having for the last few years, looking at what would really move us forward in terms of broad-based ownership and what's the role of capital in that, we zeroed in on this idea that one of the obstacles that can be removed is that of the capital and the technical assistance, and that a private equity instrument could provide that if we are certain that it would not be extractive and that it would not sort of over-leverage the companies, as Camille pointed out, has happened in the past. But our mandate on this is to really provide kind of a blueprint all the way to say what an RFP could be like for a fund manager, drum up some sense of whether there is interest in this, which I'm delighted to say is out there, right? There's a lot of potential LPs that are saying, oh my God, if this existed, it would happen. It would be great and I would make it happen. But from our perspective, the real excitement there is not on the fund itself, it's on the idea of capital at the service of labor or capital at the service of social change at scale, right? Which is something that we have not really seen meaningfully done. There's a way in which capital will be subsumed and its returns will be subsumed to the thesis of actually creating more broad-based ownership. And just to tie back to yet another webinar, so maybe you all think that we are a broken record. I remember the one with the New Hampshire Community Loan Fund and Rock USA a while back about what happens when you have residents of manufactured home parks when the the ownership of the park transitions. And you have many cases, especially recently, where private equity concerns are taking over much of this land, and some hedge funds have been moving in that space as well. And the manufactured home residents, as you know, manufactured homes are not very mobile, end up having to move away or pay dramatically higher rent. The capital that ROC USA puts together is simply rapid deployment capital that, to the extent that the manufactured home park residents want to convert to ownership, right, have the ownership of the land under them under a cooperative structure, they have the capital ready to go within the 30 to 60 days, I believe, that they have in New Hampshire to put in an alternative bid for it. So I like this model. We're seeing another one that I think Rockefeller was looking at with someone in Colombia around lining up the capital for land ownership in areas that were previously affected by the conflict. I don't think that model is very far along, so we'll be updating you on that as things develop. I'll mention one or two things very quickly, and then I want to pick up on some of the things that have come through the chat, and I believe Dennis from Impact Alpha might have a little bit to share as well. So SDGs, everybody and their mother is talking about them, and that's really the $1 trillion opportunity. Yay! As we've been looking at them, we're like, is it really transformative? Well, as you can imagine, I'm not overly excited about most of them because of the, again, thematic approach, right? That if you're investing in water and sanitation, you are per se moving towards the goal of the SDGs. No, in many cases, you're just aligning with the SDGs. And we've been fortunate to do some work with the UN, especially UNDP and the Joint SDG Fund for the 2030 Agenda, in thinking through what would be a more transformative approach and what is, again, in terms of that investor delta, the right role for the UN, which is not fund managers, frankly, to play in this. Are they in the business of diligencing early stage deals, or are they in the business of, as I'm advocating for, playing more of a governance role of sorts, right? And saying, look, these are our SDGs. We will say what are the parameters for what might count as an SDG aligned or as an SDG driving investment. The good thing about this work is that it's still very much early days, and the UN seems to be fairly open to different approaches. And in some ways, I'd say it off the record, even though we are recording, they haven't been perverted yet by a traditional approach to capital. So they are more open than many other large-scale interlocutors to this idea of saying, well, surely if you're driving this agenda, it should be something that is co-designed with the people that are affected by it, right? And surely SDG investments should not extract more value than than what they are putting in. So I am quite hopeful that something good might come of that, but we'll see. And the last piece, going back to the just transition, is along the lines of saying, look, if we're thinking about the just transition in the context of the move towards renewable energy, shouldn't we be thinking about a just transition as the world of work changes entirely? And what is the role that investors can play in that? Should investors simply be benefiting from the changes, right, and moving towards more precarious employment and yay robots and everything else that is being talked about? Or should they, especially the ones that have long-term liabilities and a long-term outlook, be thinking about, well, how does the change in the future of work now affect the world 50, 60 years from now, in the case of a pension fund or in the case of a sovereign wealth fund, and what is there that I could do or that I should be committing to do that? Not an easy question to answer. We're starting out with a kind of thought paper that we're doing together with Tonsi Whelan at NYU Stern. And again, something I'm sure many of you have thought about, right? Who is getting left behind in the changing nature of work, and what is the role that investors that are aligned with that in principle could be playing. So I will leave it at that. As you see, we haven't gotten bored recently. I'll turn it over to Dennis, who I believe has something to share with us from the great work that they've been following and reporting on at Impact Alpha. And then if others want to chime in, please feel free to send a message via the chat, and I will unmute you. So thanks, Dennis.
Fantastic. Thank you, Andrea, for inviting me on, and thank you to this community. It's a pleasure to be here. I do want to say and emphasize how much I personally draw on the thought leadership, both from a research standpoint, but also the daily dialogues you have around all these topics, and Impact Alpha and David. We all tune into what you guys are thinking on these topics. So one thing I just wanted to share is there's so many ways we sort of overlap and cover things that you all care about and are leading on. But one recent series, we've sort of created it in a series format. It's ongoing. It started as a 19-part series with Village Capital and their network and folks we were able to bring in. But really looking at the people, places, and policies, reviving entrepreneurship in the U.S., and also using entrepreneurship to drive inclusive growth in cities and communities around the country. And Andrea, you mentioned earlier this idea of transformation through finance or transforming finance. I think a lot of what we covered through the series fell in the latter category of really changing the way entrepreneurship is practiced, both building companies, financing companies, who's writing the checks. All of that is sort of playing out in a really interesting way right now. We rounded up 4 or 5 excellent journalists and released a Q&A a day for about a month in a series called The New Revivalists, and sort of a throwback to both religious and civic revivals of the past that in many ways were very inclusive and sort of came from the ground up. Anyway, we profiled folks that were somewhat familiar, possibly familiar, like Derek Brazil of Mortar in Cincinnati, Melissa Bradley of Project 500 in Washington, D.C., Arlen Hamilton of Backstage Capital, and perhaps some new faces like Brandon Dennison, in West Virginia, who's working with former coal miners, creating sort of new career pathways and pathways to ownership and sort of spinning off companies. Heather Fleming, who's working on the Navajo Nation, and helping turn informal entrepreneurs into helping them start businesses to take on some of the bigger challenges in their communities. So that was a 19-part series. It focused all on particular people and organizations. We now are on to places. While we continue to and I put a call to this community for quote unquote new revivalists. We're always looking for new folks. We just did an interview with Neighborly, who's thinking about public finance in new ways. But we just did a deep dive on Philadelphia, a profile on Austin, Peru, a dispatch from Peru on sort of the local entrepreneurship ecosystem there and how that's driving inclusive growth. Fresno, Providence, Charlotte are all up on deck, but really anywhere we're after these sort of local entrepreneurship ecosystems, investors, accelerators, entrepreneurs that are changing the way entrepreneurship is practiced. I had a few lessons to share, but I think we're sort of run up into time. I'm happy to talk to folks offline or pop on another a conference call in the future to dig into some of that.
Well, why don't you give us a couple of high-level thoughts here, Dennis, since you've tempted us, and then we'll have a specific webinar to just cover those. Yeah, if there's any high-level thought, yeah.
First is this idea, and you're seeing it everywhere, and folks here, I'm sure, are practicing it, but this place-based concept, this idea of place. Ross Baird has this word, topophilia, a love of place. And sort of what we saw across these folks are like this connection to either their hometowns or their adopted towns. And when you sort of focus on place, you sort of lose track of you take on bigger problems that you come together to solve. So it gives folks a real set of problems to work on, whether inequality, good jobs, access to capital. So you're seeing that Access Ventures in Louisville, Propeller in New Orleans, Impact PHL here in Philadelphia, Mortar in Cincinnati. How do you bring the sort of all hands on deck mentality when you're taking on place? The second one, I think this is also relevant to this community, this idea of returns on inclusion. You talk to a lot of these folks, and a lot of the work they're doing is coming from a place of expanding opportunity for folks to make a living or create jobs, and take on various ways implicit bias manifests itself. But what they find and what we found is this sort of opportunity lens that they adopt, right? So it turns out, Darren Dotson at Lumen Capital, you can train you can invest in fund managers and train them to overcome their various biases, and actually expands opportunities, doesn't limit your set of opportunities. Brian Dixon at Kapoor Capital, he's saying VCs are relying on their own networks or overlooking entrepreneurs, that a lot of underinvested in entrepreneurs are solving problems that they know a lot about. They're from their communities, their lived experiences, and those turn out are good investment opportunities as well. So just a lot of it's a bit of like a narrative shift in trying to frame entrepreneurship in a more sort of problem-oriented way, bring more folks in, expand opportunities. So we try to take on a bit of that in the series. And again, if anyone has ideas on any of that stuff or folks that we should be talking to, please reach out.
Awesome. Thank you very much, Dennis, and thank you for all the great content that Impact Alpha continues to provide. I think it's very much a must-read for a lot of us. Very cool. So if there is nothing else, I think we've covered a lot of things already. We can leave it at that. I would encourage you all to be in touch with any of us. You know who we are. You know where to find us. Or here is Kurt's email. You can get in touch with him. We're always open to hearing, especially any feedback on whether what we're doing makes sense. As you've seen, there's a ton that needs to be done, and there are not too many organizations kind of systemically trying to do it. Nor do we want to do all of it. So any kind of partnership, any redirection, if you tell us that we are misguided on where we're going, is very much the direction that we'd like to take there. So help us out. Tell us if this is helpful, interesting, if you have other ideas, and specifically with respect to the cohort and the support that we try to give to social justice leaders that are developing new capital strategies. If any of them are in your circles, either as your grantees or investees, please make sure to put us all in touch. We want to hear how we can be most helpful. You'll soon receive an invite for the next webinar. It's going to be in a couple of weeks on the work of democratizing capital East Bay, going back to Dennis's last point about place-based impact investing and how they are combining the idea of local capital accessibility with the creation of political power. So quite a punk rock thesis there, very much aligned with what we're interested in. We're honored to have supported them and look forward to telling you a little bit more about the work that they're doing. With that, I thank you all for participating. Thank you to all the presenters today. You were fabulous and concise, and you shared a lot of very helpful stuff. And I look forward to seeing you all on the next webinar. Have a good one.